So, Dan, the other thing I wrote about in GMI this month is like, I'm trying to get people to understand what this is. So, you go to a traditional asset allocator. This is what you and I grew up with as emerging markets. It's where you can make money. I wrote this article about crypto land and fiat land and how the ETF is just a trade agreement between these two different worlds, and that crypto land is growing faster, the population's growing faster, productivity's higher. So obviously it attracts capital over time.
Hey guys, welcome back to Everyday Finance. In this video, Raoul and Dan Tapiero discuss about Bitcoin and other crypto. According to Raoul Pal and Dan Tapiero, Raoul Pal is attempting to help individuals comprehend the nature of this concept. Instead of consulting a conventional asset allocator, he suggests seeking an explanation. Emerging markets have always been a lucrative opportunity for financial gains. Raoul Pal wrote an article discussing the concept of crypto land and fiat land, along with the implications of ETFs. There is a trade agreement between two distinct worlds, and the growth of crypto land is outpacing the population as productivity increases and growth accelerates. It naturally becomes more attractive to investors over time. Raoul Pal has a positive outlook on emerging markets. There has been no progress for more than 10 years. Dan Tapiero highlighted that emerging markets can be seen as a value play, as these countries have the potential for significant growth, starting from a relatively low base. Do you recall the Polish bonds from the early 90s? It's interesting to note that these countries were previously under communist rule. There were no economies. China was considered a non-factor in the late 90s. According to Tapiero, the GDP was $1 trillion, which is slightly larger than the size of Canada. These countries did not have any economic significance, and lots of things Raoul Pal and Dan Tapiero discuss. So please watch the video to end, and share this video, and subscribe our channel Everyday Finance. Thanks.
I'm a free markets guy from the 80s and 90s. That all came out of the Reagan era. And every effort to sort of tamper with the markets, to me, sends wrong signals. And, I think that's probably why we're in the position we're in now with the federal deficits and, the old fiat system. There's just too much interference, right? I think you and I both agreed somewhere in the early 2000s, 2010, I'm not sure, the pricing signals that we used to look at in the 90s and 2000s that were more pure, they've gone away, right? The market doesn't price assets based on, I think, value. You have all these different actors and there's politics involved. So I really appreciate that. I know that's not something that people talk about much.
Also, Dan, the other thing I wrote about in GMI this month is I'm trying to get people to understand what this is. So you go to a traditional asset allocator. This is what you and I grew up with as emerging markets. It's where you can make money. I wrote this article about crypto land and fiat land and how the ETF is just a trade agreement between these two different worlds, and that crypto land is growing faster, the population's growing faster, productivity's higher. So obviously it attracts capital over time. And I think, emerging markets have gone nowhere for over a decade now, some 2 decades, some 3 decades. And you're here is an emerging market that's growing faster than any other emerging market you've ever seen. That old emerging market allocation should really be a crypto allocation. That's what I'm starting to get my head around.
Yeah, but I think crypto is bigger than emerging markets.
I know, this is really this is for the traditionalists to try and get them to understand. It's much bigger, obviously, because this emerging market takes over the world.
Yeah, I think that's right. I mean, the emerging market play was also a value play. These countries were starting at zero. You had, you remember those Polish bonds in the early 90s. And, these are countries that were in communist, and there were no economies. China was a zero. I think it had, in the late 90s, China's GDP was $1 trillion. I mean, just a little bit larger, I think, than the size of Canada, right? So these countries didn't exist in an economic sense. And so I think that was catch-up.
But isn't that the same thing?
London's role in initiating the FX market in the 60s is significant due to the United States' implemented protectionist policies after abandoning the gold standard, followed by the United Kingdom. It is important for everyone to exchange currencies with each other. We can arrange this in London, as the US has been imposing restrictions on currency control. London became the dominant lending market, specifically for the euro-dollar market. After taking over from the US banks, the UK played a significant role in establishing the largest market the world has ever witnessed similarly. A similar occurrence took place with derivatives due to the presence of the CME and CBOT in the US. The UK made changes to its banking system. The US missed out on the opportunity to tap into the $1.4 quadrillion OTC derivatives and swaps market due to regulatory restrictions. Everyone from the FX market to the derivative market gathered at Goldman's headquarters in New York. However, the intellectual hub was in London, where the profits were also being made TRA. And Raoul Pal believed that we are heading in that direction. To reiterate the same point, Raoul believes that there is some unease in the US regarding its status as a reserve currency and its position in the global landscape. Let's back to the Raoul Pal interview.
Isn't that the same thing?
This is the application of math and computer science and, game theory and sociology, psychology, to I think the entire world of value. So it's much bigger than just some countries, catching up and growing. It's just that there's a complexity here that's difficult to understand, and you really need to spend a lot of time to focus and understand why it's such an important. I call it invention. This is the first time we did that first interview in the middle of 2019.
Security truth machine.
Yeah, and I think that's really what it is. What's a bit strange is that, you have people in positions of authority in the US like Gensler who are, actively attacking. So it's not that it's even a neutral. He doesn't talk about all the benefits ever. I mean, it's absurd. So now we have other countries around the world that have done the work. Singapore and Hong Kong and the UAE. London is moving ahead a little bit. And I think that businesses are drifting there that are in the digital asset universe, and people are trying to stay away from the US. For now, I think it's just for now. It is curious to me. Do you have a?
Well, my mental model for this is the fact that London started the FX market
right
in the 60s because the US had protectionism once it got off the gold standard, or the 70s.
Right.
And then the UK said, well, everybody needs to now swap currencies with each other. We'll set it up in London. The US was being restrictive. They had capital controls. So that London took that over, then became the lending market, which was the eurodollar market. The US stopped their banks doing it. So the UK took it, created the biggest market the world has ever seen. Then, same thing happened with derivatives because we had the CME and CBOT in the US. The UK changed the bank regs to allow OTC derivatives, and the swaps market came, which became $1.4 quadrillion. The US missed that all. So if you remember, you and I would generally meet in London in past days.
Yeah, of course.
Everything was in London. The FX market, the derivative market, everybody was there. Goldman's headquarters, sure, was in New York, but the intellectual capital was all in London. So were the profits.
The trade.
And I think we're just going to repeat the same thing. I think the US is a bit nervous about its reserve currency status and how it fits in with this world. So
really?
London,
I'm not really there. I don't think that there's anything that's really going to challenge the dollar in the fiat world.
I don't either, but they seem scared of it.
I know. Well, the dollar has gone down. If you look at, it the other way, 99% against Bitcoin in the last 10, 11 years. I mean, people have lost huge amounts of purchasing power who have not moved into this world. And again, that's the risk, I think, of the TradFi people of not moving in, is that their wealth, the value that they have, continues to erode. And we've talked about this again before, that I think that instead of a debt jubilee or debt problem, what happens is that debt just very slowly sits in the traditional world and devalues versus everything in the digital world. And so you have the digital asset ecosystem that's debt free. And so it's a pure market, it's clean. This right now is the beginning of the normie, traditional corporate world adoption of Web3, blockchain, crypto, digital assets, whatever you want to call it. It's happening now. At the end of the last bear phase, we didn't have hundreds of companies like trying to figure out how to like incorporate NFTs into their, business model. Now you've got Adidas and LVMH and Nike and all these giant companies on that end. You've got Franklin Templeton and Fidelity and BlackRock. I mean, the buying hasn't happened yet, but they've put down their stake and they've said to the people in Washington, listen, we control trillions of dollars of assets. Okay, we want an ETF. All right, so that's great, but that's just a conduit for capital. Can you imagine what's going to happen when the people at those institutions understand that that is just the very beginning of what's so interesting about this world, right? Just buying Bitcoin and Ethereum, I mean, big deal, right? Like that's great. But it seems they don't have any greater conception for what's going on, which I would call is the digitization of all value that exists in the world. At some point, will sit on a blockchain somewhere in this D8, as I call it, right? And that's where we're going.
I agree. And, when people ask me, what do you think of the structure of the bull market that lies ahead? My view is probably similar to yours. It's everything, everywhere, all at once. Because
it is. And it's building. I know. I completely agree.
It's like we know we're going to digitize finance and everybody's working on it. All of the big shops, plus all the private sector. We know the NFTs and their applications, and with the Solana compressed NFTs means you can make millions of them for cheaper than printing a ticket. So that's ticketing. There's all of these structures that are all going to come together because everyone's been building. I mean, you see it because you've been investing in this. Most people can't see it until it's in front of their faces. But we all know what's coming because everybody's been working on this shit forever.
If we consider the situation from a different perspective, it becomes evident that the value of the dollar has decreased. The overwhelming majority is opposed to Bitcoin. In the past decade, there has been a significant decline in people's purchasing power, resulting in substantial losses for many individuals. It's important to consider the potential risks of people not moving into this world. The value of their wealth continues to erode, and we have discussed it. Let's revisit this topic once more. Dan Tapiero has a different perspective on addressing the issue of debt instead of a debt jubilee or debt. The issue at hand is that debt tends to accumulate gradually in the traditional setting. The digital asset ecosystem is a pure market that remains debt-free, which sets it apart from the rest of the digital world. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.